Growing a small trading account is one of the most important periods of your trading journey. If you know a consistent growth formula, the proper habits and techniques, you can later inject that same exact process with a larger amount of capital to be able to get to the profit levels that you want. But if you're trying to jump the gun, start with way too much money, it's much easier to build bad habits, trade emotionally, and struggle as a trader. In this video, I'm going to outline the same growth formula that I now use to be able to bank $2,000 to $3,000 on my full profit trades so that you can work on following a proven framework to reduce your mistakes and focus on a good process to scale your account. All right, so let's jump right into it. So step one of following this growth formula framework is going to be preventing simple mistakes by following a system checklist. Anytime you're entering a trade, you have to follow specific back-tested trade criteria. Now there's two major types of trade criteria. There's mandatory criteria and then confluence criteria. So let's break down each and why they're important. I'm going to use an example of a trade I alerted out 2 days ago to the private team, where I alerted entry here, stop loss here, take profit up here. And you can see within a few hours, we were able to hit full profit on this. Now, the reason I was able to alert this out with conviction is because we have that tested system and because I'm using the entry criteria checklist that I've set up for myself for this system. But an example of mandatory entry criteria is something that you need to have in order to even entertain the idea of entering the market. So in this situation, okay, I need this specific level to reach a certain point, okay, and I needed the area I was going to enter to be right at this green line here. Those are mandatory entry criteria for me. Now, I was watching this same general setup, but on multiple pairs at the same time. This is where our confluence criteria is going to come into play. So confluence criteria is going to be any supplemental analysis that we notice helps confirm that the trade is going to work, but isn't necessarily required for entry. The good thing about confluence criteria is it's going to vary between pairs. Now we can see I was looking to enter here and we had a very similar formation on Shiba. I was actually debating between both these setups. As an example of confluence, I like to see a lower highlight strip here and a higher highlight strip along my lowest point of the trend here to confirm a reversal. And this is something that I've noticed helps me pick the direction of trades and pick the best pairs. If we look at the same thing on Shiba, you can see higher highlight strip, higher price action, lower highlight strip, lower price action. This isn't giving me divergence, so therefore this pair looks weaker, which is going to cause me to choose the AVAX trade up here. And in fact, this trade never even came to my full entry. So even though we're seeing similarities between charts, those extra layers of conviction are going to help you decide between pairs and pick the best setup for the system. Step two of the growth formula framework is going to be being exactly precise about your entries. Now, we always talk about not leaving trades early, but actually being very punctual about your entry is probably the biggest make or break thing you can do with your trading. And I'm going to explain exactly why on the chart here. So say I'm looking to get in at this specific level here. I place my stop loss exactly here. We can see this is giving us 3.67 risk factors, meaning that's the multiple of what we're risking on the trade if the trade is to go full profit. If we're risking $10, we're going to make $36.7, $100, we're going to be making $367 and so on. So this is our risk multiple if we're working in factors of R. Okay, so if I go ahead and play this forward, say the price comes down, I thought about getting in, but I hesitated a little bit and I say, oh, well, it's still pretty close to my entry. I still want to take part in this trade. It's not going to matter too much if I get in a little bit late. So then you decide to move your entry up to this level and let the trade come to fruition. All right, and you can see right here, trade goes full profit. And now we're closed out of the trade. Everything is good. So between these two entries, we only have a distance the size of this cube, but let's play these scenarios out over 10 trades. So scenario one is our original entry point down here. If we're making 3.67 risk factors over 10 trades, say we're only right 30% of the time. Usually on the premium team, we're right about half the time, but say we're having a really bad week and we're only winning 3 out of 10 trades. Okay, that means we're gonna get 3 wins times this many risk factors. That's going to give us 11 positive risk factors minus the 7 negative risk factors for the loss. That's going to give us a net of 4 total risk factors. Say we're risking $500 on each trade the way I do. That's $2,000 in profit over 10 different trades. So let's take scenario 2 where we move our entry just by a hair. Okay, still taking 10 trades with a 30% win rate. Over 3 trades, that's going to give us only 6.69 positive risk factors. We're still gonna have the negative 7 risk factors, which is going to leave us for a total of negative 0.31 risk factors risking $500, we're actually going to now be down $155. So you might be thinking it's just the difference of this and that, not that much. But amplified over a large sample size, being very precise about this entry is really, really important. Now, I also want to emphasize another point. If we were to take that same difference, but we were to take profit early at the top by that same amount, so instead of our take profit being here, we take profit here, even moving our take profit down by that much, in the same exact scenario, we're still only winning 3 trades. That's giving us 9.33 risk factors, a total of 2.33 risk factors at $500 risk per trade. Now we're still profiting $1,165 over 10 trades. So you can see the entry is exponentially more important about being precise on than our exit point. This is a common mistake that's going to eat into your profits. Even when you're right, you're decreasing the size of your position if you're chasing. And when you're wrong, it's going to make the loss even bigger than you expect. Not doing this is going to help you exponentially grow your account and stay on pace with your growth goals. And these are the seemingly small things that you have to focus on that other people don't, that are going to set you apart. Okay, and these are the concepts that we're pushing to our premium team members. You can see Samuel here doubling his account after 4 months of trading on premium. Okay, we can see Mo Diddy has a 79% win rate, a lot better than the scenario with the 30% win rate that we were talking about. You can see right here, working in risk factors, not focusing on profits in dollar amounts, but focusing on the proper way to take trades and being precise with the things that matter. But let's go into step 3 of the growth formula framework, which is keeping uniform risk per trade and deciding whether you're going to do a rolling percent growth or you're going to be a fixed dollar benchmark. Now we're going to take a look at both of these processes and sort of weigh the pros and cons of each. Let's go over the running percent growth method first. So say for example, let's take our previous example here where our entry level is going to be right here, stop loss is right here. So once again, if this price trades down to this level, we are going to get out of the position for a contained small loss. That's a rudimentary concept of proper trading. So if we start with say a $100 account, if we're risking $10 per trade, that's going to be a 10% risk on the account as a starting point. Now, let's say we make 1 to 3 risk reward on a trade. That's going to give us 3 times $10 risk plus $30 added to the $100 initial balance is going to give us $130 on the account. We can then multiply that by 10% to set our new dollar amount risk, which is going to move up to 13. So then the next trade that you take, you're going to enter your position so that this risk, which previously was $10, is now 13. And that's a way to gradually, consistently scale up your account. Okay, and if you're wondering how you can position size in these things, we have a bunch of tools. This is a really cool trading view tool. I'm going to put this in the description in the resources section. If you want to check it out, you can click on it and add it to your trading view. Basically, once you click on it, it's going to prompt you to enter your price. I can click on my entry level here, my take profit and my stop loss, submit the dollar amount that I want to trade. And it's going to give me a box of exactly how many units I have to enter at this level to risk that specific dollar amount and how much profit I'm estimated to make at my take profit level. The only downside about doing the running percent growth is that as your account gets bigger and turns into weird numbers, you're always calculating what your specific risk is and you're working with weird benchmark numbers. And that's not necessarily something that I want to be focused on when I'm trading. Okay, so the second method, and this is the method that I use, is once again starting at 10% of your account. So if you're starting with a $100 account, you put 10% of risk on, which is $10 at a 1 to 3. You're still making that 130, but instead of graduating up to $13 risk per trade, you keep it at that $10 mark until this 130 hits 200 in the account. Then every time you double the account, you take 10% of the doubled amount, and that's your new uniform risk factor. That way you're not trying to do the math on, what's 7.5% of 15,321 while you're trying to get in on a day trade, right? Easier to say, I risk $100 per trade. If I make a 1 to 3, I'm going to make $300 in profit. Adding that clarity is something that I find beneficial for my mind, but these are 2 ways to do it. Now, I also know that in the comments, people are going to say
10% risk on your account. This guy has no idea what he's talking about.
Okay, so first of all, if you're starting with a $500 account and you really want to risk $5 per trade, even though you know your trading system works over 10 trades, be my guest to take as much time as you want. But if you know your process works and you know that you can make plus 2 or 3 risk factors, even being wrong 70% of the time, why would you want to risk $5 on 500 to make $15 when you can use leverage and risk $50 on that account account because you have your system back tested and you know what the result is going to be over 20, 30 trades that you take. Now, what I will say is that as you get your account to larger levels, say $20,000, $30,000, risking 10% of that account still is maybe not the wisest idea because you're going more into capital preservation mode. So even if your position, say, requires $26,000, if you're in Forex or if you're in crypto, you can use your leverage, say 25x, and now the cost of that trade is still going to be 1,000. So you can actually use $500 accounts, and even though the position size would require $6,000, $10,000, if you're using this leverage, it's going to cost a fraction for you. And as long as you're quantifying your risk, $10, $50, this is a way that people can expedite the growth of their account. All right, step 4 of the growth formula framework is going to be finding pairs and setups that are favoring your direction. Okay, there's something that we use called beta coefficient. So the beta coefficient is going to show you the strength of that individual pair compared to the indexes or the big players in the game. In the crypto world, okay, that's going to be Bitcoin. So we can see this line here on our NeverTrade Pro Plus indicator, which is a custom indicator we have in our community. This line either turns green or red, depending on how strong or weak this pair is in comparison to Bitcoin. So say, for example, I'm looking to long this pair. This is substantially weaker than Bitcoin. That means that AVAX is going to move even harder against me. And even if Bitcoin moves up by a lot, AVAX is going to be trailing behind Bitcoin because it has a negative beta coefficient. You want to pick pairs that are going to be strong in the general direction of the market so that when you're doing your larger time frame, multi-time frame analysis to determine where you should be trading your smaller pairs, you're not picking setups that are going to be fighting the natural trajectory of the market that you're trading. So if you want to play around with this indicator, we use it to find divergences and we use it for the beta coefficient. I'm also going to put that in the resource document in the description of the video for you guys. In step 5 of the growth formula framework is going to be surrounding yourself with people who are not degenerate gamblers, who actually understand these principles and are going to be good influences on yourself. I was reading a statistic today where even surrounding yourself by high performers or higher performers than you can increase your performance by 15% statistically. Whereas if you surround yourself by underperformers, you can lose 30% of your performance. This was done over sales data. The same thing is applicable in life and in trading. Surround yourself with people who have the proper framework and are focusing on these things. Okay, and stay away from people that are degenerately buying options contracts where they have no system, no back testing, and they're essentially just gambling. Because as you get into this game, you have to be very specific and very detailed to even remotely get close to making it, and those are not the types of people that you want to surround yourself with. And that's why we have the NeverTrade community. We have all of this framework set in place, and we have full sections for people to submit trades, share their trade, talk about all of the systems, ask questions, and work alongside one another to really advance themselves with this material. And actually, I want to give a big shout out to Matthew. Okay, Matthew actually met up with Andrew the other day, and he was explaining to us from working with us and using our infrastructure, he's used $1,500 to turn it into $10,000 over some time. Just very proud of that story. Big shout out to you, Matthew, for crushing it and being an inspiration to everyone. So if you follow this framework, it's going to put you way ahead other people, and it's going to allow you to scale your account gradually, consistently, and safely. Anyways, guys, if you're still here, make sure you hit the like button on the video, subscribe to the channel if you like trading and investing, give us a follow on Instagram, check out our Discord. We have an amazing trading community. But until next time, guys, I will see you all in the next video.